Estate planning gone wrong, a last-minute family limited partnership, a telling email, and the Fifth Circuit decision that wiped out otherwise valid appraisal discounts. Hi, and welcome to News from Last Quarter, where I spotlight the most important articles and court decisions featured in Business Valuation Quarterly Brief, my new newsletter. In the state of N. Miller Fields versus Commissioner, about 17 million of assets were transferred into a family limited partnership after Miss Fields' health deteriorated and just a couple of weeks before she entered hospice and passed away. The partnership had primarily passive investments, such as marketable securities, bank stock, interest in a couple of LLCs, and a tree farm. The state's appraiser applied a 15% discount for lack of control and 25% discount for lack of marketability, reducing the reported value to roughly $11 million. But the IRS argued that the partnership had been created primarily to reduce estate taxes. One piece of evidence was an email asking for deeper discounts. The court agreed. It concluded that the partnership lacked a substantial non-tax purpose, citing the timing of the transfer, the largely passive assets, the limited operational changes, and the deeper discount email. Applying RSC Section 2046, which basically says that the person needs to keep the benefit of or control who benefits from the property, the Fifth Circuit held that the state had to include the full value of the transferred assets and not the discounted partnership interest. The court never criticized the DLOC or DLOM. Because the legal structure failed, the valuation discount disappeared. Why it matters? This case reminds us that estate planning comes first and valuation second. A technically sound appraisal cannot rescue a planning structure that fails IRC Section 2046. And please read the full piece in my Business Valuation Quarterly Brief, linked in the description. See you next time.
Gatto Consulting, Business Valuations, Fractional Financial Services, Strategy, M&A.